I'm going to tell you something that will infuriate every financial advisor watching this. If I were starting today with just $10,000, I could turn it into $1 million faster than most people with $100,000 will. Not because of some secret strategy, not because of insider knowledge, but because small amounts of money have advantages that large amounts don't. And almost nobody understands this. I'm Warren Buffett, and over 7 decades, I've learned that the size of your bankroll matters far less than how you think about deploying it. When I started with small money, I had opportunities I can't touch today with billions. The tragedy is watching people with $5,000 or $10,000 act like they're handicapped, like the game is rigged against them, when they're actually sitting on the most powerful investing position possible. Today, I'm going to explain exactly how to invest small amounts of money, why you have advantages billion-dollar funds would kill for, and the specific strategies that work when you're starting with almost nothing. Here's what nobody tells you. Having small amounts of money is not a disadvantage. It's a massive advantage if you're smart enough to use it. When I was managing small sums in the 1,950 seconds, I could generate 50% annual returns relatively easily. Today, managing hundreds of billions at Berkshire Hathaway, I'd be thrilled with 10%. That's not because I got worse at investing. It's because size is an anchor. Let me explain why small money is powerful. First, you can move in and out of positions without moving the market. When Berkshire wants to buy a stock, we need to accumulate billions of dollars worth. That takes months, sometimes years. We can't just buy, we drive the price up against ourselves. You can buy $10,000 worth of anything in 30 seconds. You're nimble. That's valuable. Second, you have access to thousands of opportunities I can't touch. There are small companies trading at absurd valuations that would make me rich if I could deploy meaningful capital into them, but I can't. A $50 million company doesn't move the needle when you're managing $300 billion. For you, that $50 million company could be a 10-bagger that changes your life. Third, you can concentrate. This is huge. When you have $10,000, you can put $2,000 into 5 high conviction ideas. That's 20% positions. Try doing that with $100 billion. The risk management requirements, the regulatory issues, the liquidity concerns, they all disappear when you're small. I've said this publicly many times. If I were managing a small amount of money today, I would be looking at companies with market caps under $500 million, maybe even under $100 million. I would be finding tiny, overlooked businesses trading below their intrinsic value. I'd be putting 20-30% of my capital into my best ideas, and I'd crush the market. But you can't do that when you're big. Size kills returns. That's just mathematics. So stop thinking of small capital as a handicap. It's a superpower if you know how to use it. Rule number 1, every dollar must have a job. When you're starting with small amounts, you cannot afford to be casual about capital allocation. Every dollar must be working. There's no room for waste, no room for lazy thinking, no room for, I'll just park this in cash because I'm not sure what to do. Here's how I think about it. Imagine each dollar is an employee. Would you hire an employee and pay them to sit around doing nothing? No. You'd either give them productive work or fire them. Same with your capital. Every dollar should either be deployed in a productive investment or returned to you. And when I started, I was fanatical about this. I didn't have money sitting idle. If I couldn't find a good investment, I'd return money to partners rather than hold it earning nothing. Today, Berkshire holds a lot of cash because we can't find enough good opportunities at our scale. But when you're small, there's no excuse for idle cash unless you're specifically saving for an identified opportunity. This means you need to be decisive. You need to develop conviction. You need to do the work to understand an investment well enough to commit capital. Paralysis is expensive when you're starting out. The opportunity cost of doing nothing compounds against you. Now, I'm not saying be reckless. I'm saying be purposeful. If you have $10,000 and you're waiting for the right time while it sits in a checking account earning 0.5%, you're losing purchasing power to inflation, and giving up years of compounding. That's not prudent. That's fearful. And fear is expensive. Rule number 2, focus on return on capital, not absolute dollars. This is critical, and most people get it backwards. When you're investing small amounts, you need to think in percentages, not dollars. A 30% return on $10,000 is $3,000. That doesn't sound life-changing. So people get discouraged and either give up or start gambling, trying to make bigger. Absolute dollar gains. Wrong mindset entirely. That 30% return is what matters. Because if you can generate 30% returns consistently, the absolute dollars take care of themselves through compounding in year 1. 30% on $10,000 is $3,000. In year 10, if you keep compounding at 30%, that $10,000 becomes $138,000. By year 20, it's $1.9 million. That's the power of focusing on the rate of return rather than the absolute dollars. Too many investors with small amounts try to hit home runs because they're thinking, I need to turn this $5,000 into $50,000 quickly. That mindset leads to speculation, excessive risk-taking, and usually catastrophic losses. Instead, think like this. How can I generate the highest sustainable return on this capital? If you can consistently generate 25% annual returns on small amounts, which is very achievable, if you're disciplined, you will become wealthy. It just takes time. When I was young, I wasn't trying to turn $10,000 into $100,000 overnight. I was trying to find investments that would give me 30-50% returns with minimal risk of permanent capital loss. I did that year after year. The absolute dollars started small, but the returns compounded. That's how you build wealth from nothing. Rule number 3, invest in what you can understand completely. With small amounts of money, you have one massive advantage. You can become an expert in a narrow area and exploit that knowledge. You don't need to understand every sector, every industry, every type of business. You just need to deeply understand a few things and invest in those. This is your circle of competence, and when you're small, your circle can be very small and very deep. Maybe you work in healthcare and you understand medical devices. Maybe you're in technology and you understand software businesses. Maybe you're in retail and you understand consumer behavior. Whatever it is, use that knowledge. I started by investing in things I could touch and understand. Early on, I invested in a gas station, a farm, even a pinball machine business. I could see exactly how they made money. I could count the quarters coming out of the machines. There was no mystery, no complexity, no dependence on macro factors I couldn't control. As you grow your knowledge, your circle of competence expands. But the principle stays the same. Only invest in things you genuinely understand, not things you think you understand because you read an article, not things that sound impressive. Things you can explain to a 10-year-old in 3 sentences. Here's the test. Can you explain how this business makes money? Who are the customers? Why do they buy? What are the costs? What could go wrong? If you can't answer these questions clearly and simply, you don't understand it well enough to invest. When you have small amounts of money, you can't afford to learn expensive lessons about businesses you don't understand. Every mistake costs you years of compounding. So stay within what you know. Get really, really good at evaluating a specific type of business, then deploy capital only when you find opportunities within that narrow expertise. Rule number 4, look where others aren't looking. Here's where small money becomes a genuine superpower. You can invest in places that institutional investors literally cannot go. And those places often have the best opportunities. I've said this before, if I were running a small amount of money, I would be looking at microcap stocks, special situations, spin-offs, deeply discounted bonds, regional banks, tiny industrial companies, anywhere that's too small for large investors to care about. Why? Because when professionals can't invest in something, it often trades at irrational prices. There's less competition, less analysis, less efficient pricing. That's where you find bargains. In the 1,950 seconds, I made fortunes buying stocks trading below their net current asset value. These were companies where you could subtract all liabilities from just the current assets, cash, inventory, receivables, and still have more value than the stock price. You were buying dollars for 50 cents. Why did these opportunities exist? Because they were too small for institutions. Most investors never heard of them, but I could buy them because I was small. Today, those exact opportunities still exist. Not in the S&P 500, not in the headlines, but in tiny companies trading on exchanges most people never look at, in court-ordered liquidations, in family businesses going through generational transitions, in spin-offs that big funds sell automatically because they're too small. Your job with small money is to become a detective. Look at SEC filings for small companies. Read local business journals. Follow bankruptcy proceedings. Look at stocks trading below $5 that institutions often can't own due to internal policies. That's where you'll find mispriced opportunities. Warren Buffett partnership made outsized returns in the 1,950 seconds and 60 seconds, not because I was smarter than everyone else, but because I was looking in places others weren't. I was small enough to care about $500,000 market cap companies. That flexibility created enormous opportunities. Rule number 5, concentrate when you have conviction. This might be the most important rule for small money investing, and it's the one that makes financial advisors the most uncomfortable. When you have small amounts and you find a truly great opportunity, you need to bet big. Diversification is for people who don't know what they're doing. I've said this for decades, and it's especially true when you're small. If you have $10,000 and you spread it across 50 stocks, you've built a mediocre index fund. You'll get mediocre returns minus your trading costs and time. Congratulations, you've wasted effort to guarantee average. Instead, when you're small, you should concentrate. If you find 5 truly excellent investments that you understand deeply, put 20% in each. If you only find 3, put 33% in each. If you find one exceptional opportunity, consider putting 40-50% in it. This sounds crazy to modern portfolio theory advocates. But here's the thing. Diversification protects you from ignorance. If you don't know what you're doing, owning 50 stocks means when you're wrong about some, the others save you. But if you actually know what you're doing, if you've done the work, understand the business, bought at a good price, concentration is how you get rich. My largest positions in the Buffett partnership were often 40% of the portfolio. Berkshire Hathaway itself has had 20-30% positions in single stocks. That's not reckless when you understand what you own. That's confidence backed by analysis. The formula is simple. Diversification when you don't know what you're doing, concentration when you do. And when you're investing small amounts, you better know what you're doing. You don't have the luxury of being casual. So find your best idea, your absolute best, highest conviction, most thoroughly researched opportunity, and size that position meaningfully. Not 2%, not 5%. Something that actually matters. If it works, it changes your trajectory. If you're wrong, you'll learn an expensive lesson that makes you better. Either way, you're in the game. Rule number 6, reinvest everything. This seems obvious, but most people violate it constantly. When you're building wealth from small amounts, you cannot afford to withdraw profits. Every single dollar of gain must be reinvested. This is non-negotiable. I didn't take a salary from Buffett Partnership for years. Every dollar we made went back into investments. When Berkshire started paying me a salary decades later, it was $100,000 per year, basically nothing relative to my wealth. Why? Because I understood that every dollar I took out was a dollar that couldn't compound. Let me show you the math. Say you start with $10,000 and generate 25% annual returns. Scenario 1, you reinvest everything. After 20 years, you have $867,000. Scenario 2, you withdraw $2,000 per year in profits to spend. After 20 years, you have $287,000. That withdrawal cost you $580,000. Every dollar you take out early costs you 10, 20, 50 times that amount in lost compounding. It's the single most expensive mistake small investors make. They have a good year, make $3,000, and blow it on a vacation. That $3,000 could have been $30,000 in 10 years. Was the vacation worth it? Now, I understand you need to live. I'm not saying starve yourself. I'm saying build your life so your living expenses come from your income, your job, your business, not from your investment capital. Your investment capital is sacred. It's your seed corn. You don't eat seed corn, no matter how hungry you are, because then you can't plant next season. This is especially true in the early years. For the first decade of building wealth, you should be adding capital to your investments and reinvesting all gains. That's how you accelerate compounding. Once you have a meaningful base, say $500,000 or $1 million, then maybe you can think about taking some money out, but not before. Rule number 7, be patient with good businesses, ruthless with bad ones. Here's a paradox in investing small amounts. You need patience and impatience simultaneously. Patience with your winners, impatience with your losers. When you buy a good business at a fair price, your default should be to hold it indefinitely. Not for a year, not until it's up 50%, indefinitely. The goal is to let your winners run as long as the business fundamentals remain strong. My favorite holding period is forever. Why? Because when you sell a winner, several things happen. You pay capital gains taxes, immediately losing 20% to the government. You have to find another equally good investment to redeploy into. And you stop compounding in a business you already know is good. All of these are headwinds, but with losers' businesses where your thesis breaks, where management disappoints, where the competitive dynamics deteriorate, you need to be ruthless. Sell immediately. Take the loss. Move on. Don't hope it comes back. Don't wait to break even. That's ego talking, not logic. I made this mistake early in my career. I'd buy something, it would go against me, and I'd hold on hoping I was right. Sometimes I was, but often I was just wasting time and capital on a mediocre business when I should have moved to something better. So the rule is be patient with businesses, impatient with prices. If the business is doing well, but the stock price is flat, that's fine. That's often opportunity to buy more. But if the business is deteriorating, the stock price is irrelevant. So this is how you maximize compounding with small amounts. Your winners compound for years or decades. Your losers get cut quickly before they do real damage. Over time, your portfolio becomes concentrated in your best ideas that have proven themselves. Rule number 8, live below your means to accelerate capital accumulation. This isn't directly about investing strategy, but it's critical for building wealth from small amounts. The fastest way to turn $10,000 into $100,000 isn't finding a 10-bagger. It's saving another $10,000 and another, and letting all of it compound. When I was young, I lived far below my means. I lived in a modest house, drove an old car, didn't spend on luxuries. Not because I was cheap, though I've been accused of that, but because I understood every dollar I saved could be deployed into investments. Every dollar spent on consumption was a dollar that couldn't compound. This is the part most people don't want to hear. They want investing advice that doesn't require sacrifice. But here's reality. If you're earning $50,000 per year and spending $48,000, you're adding $2,000 per year to investments. If you're earning $50,000 and spending $35,000, you're adding $15,000 per over a decade. That's the difference between having $20,000 invested and $150,000 invested before any returns. The math is simple. The discipline is hard. Most people inflate their lifestyle with every raise. They make more, they spend more, and they never build capital. That's why doctors and lawyers making $300,000 per year often have less wealth than disciplined savers making $60,000. Your goal in the wealth building years, roughly ages 20 to 50, should be to maximize the gap between what you earn and what you spend. Live like you earn half what you actually do. Deploy the difference into investments. Let it compound. The lifestyle upgrades can come later when you build real wealth. I still live in the house I bought in 1958 for $31,500. I could afford any house on earth, but that house serves its purpose. Every dollar I didn't spend on a mansion compounded for 60 plus years. That's how you build generational wealth. All right, let's get specific. If I had $10,000 today and I was starting over, here's exactly what I'd do. First, I'd keep $1,000 in cash as a small emergency buffer. Not in the investment account, in a separate high-yield savings account. Just enough so a car repair doesn't force me to sell investments at the wrong time. With the remaining $9,000, I'd do this. I'd spend 3 to 6 months reading annual reports of small companies. I'm talking companies with market caps under $500 million. I'd look for businesses that are profitable, have little or no debt, are trading below 12 to 15 times earnings, and are in industries I can understand. I'd look for companies where insiders own significant stock management with skin in the game. I'd look for businesses with competitive advantages in boring industries, regional banks, small manufacturers, niche software companies, family-owned businesses that just went public. I'd find 5 businesses I understand completely where I can articulate the bull case and the risks in 5 minutes. I'd put $1,800 in, each 20% positions. Then I'd do almost nothing for a year except read their quarterly reports. If one position doubles, I'd consider taking half off and redeploying into my 5th or 6th best idea. If one position drops 30% but the business fundamentals remain strong, I'd add to it. If one position drops because the business is deteriorating, I'd sell immediately and move to something better. I'd save every dollar I could from my job, let's say $500 a month, and add it to the investment account quarterly. I'd look for new opportunities constantly, but only deploy when I found something better than what I already own. I wouldn't check prices daily, maybe once a week. I'd focus on business results, not stock movements. And I'd plan to do this for a decade minimum before even thinking about withdrawing money. That's it. That's the whole strategy. It's boring, it's patient, it's disciplined, and it works. Let me end with this. Having small amounts of money to invest is not a problem. It's an opportunity. You have flexibility that billionaires don't. You have access to opportunities we can't touch. You have the ability to concentrate in ways we can't. The question isn't whether you can build wealth starting with $5,000 or $10,000 or $25,000. You absolutely can. The question is whether you have the discipline to do it properly, whether you can avoid the stupid mistakes that destroy most small investors, whether you can think long-term in a world demanding instant gratification. I started with small amounts. So did Charlie Munger. So did almost every successful investor you've heard of. None of us had millions to start. We had modest sums, sound principles, and decades of patience. That's still the formula. So stop making excuses about not having enough money. Stop waiting for the right time or the perfect opportunity. Take what you have, deploy it intelligently, live below your means, reinvest everything, and let time do the heavy lifting. In 30 years, you'll be wealthy. Not because of luck, not because of genius, but because you understood that building wealth from small amounts is entirely possible if you think correctly about capital allocation. Now go do the work. Read annual reports. Find good businesses. Buy them at fair prices. Hold them patiently. Add capital consistently. And don't do anything stupid. That's how you invest small amounts of money. That's how you build wealth. And that's how you compound your way to financial independence, regardless of where you start.